Hello, everybody, and now we're going to talk about cash secured puts for passive income. We've covered calls, no pun intended, right? We've covered calls. That just okay. Anyway, but now we're going to talk about cash secured puts for passive income. So, basic options terminology. I'm just going to remind you guys one more time. Call option. Remember, call up, put down. Strike price. The price of the option must be above in the case of a call or below in the case of a put on expiration day, or the option will be considered worthless. Expiration day after the market close of this day is when the option ceases to exist and has $0 in value. So once again, we've already been over that, but just some basic options terminology in case you skipped around and you want to write this down there as well, or you forgot to. What is a cash secured put? Well, a cash secured put is an income strategy that allows you to get paid for being willing to purchase stocks at a specific strike price. And so it's a bullish strategy. So if you think about, we went over some examples in the last video and we'll go over some more examples, but essentially like MasterCard, Apple, right? If you want to buy Apple at a discount, what you can do is sell a cash secured put. And this actually allows you to get paid for purchasing stocks. Believe it or not, it's my favorite way to purchase stocks because what's happening is you buy the stock and let's say the stock's at $315, but you sell a cash secured put at $300 per share. Well, what happens in this situation is that you get the premium, and then if you get long at $300, it's like you're buying the stock at a discount, and you're not just paying the sticker price, which is $315. Instead, you're actually getting a bid in for the stock, and then if the stock ends up dropping to your level or lower upon expiration day, then you'll get exercise those shares or exercise the option, and you'll basically get long those 100 shares at the strike price. And so you can buy stocks at a discount. That's what is so cool, getting paid to buy stocks. Who would have thought that this could be done? But this is what the professionals do a lot of times. They get the premium and they get the profit from the trade. So an example of a cash secured put, let's go over this. So the first thing to keep in mind is, let's say you believe XYZ stock is currently trading at $50 per share, and you don't believe it's going to move much in the next couple of months. Let's just say that you think it's going to do absolutely nothing. It's just going to kind of sit around and, hang around in the la-la land, right? Just kind of twiddle its thumb a little bit and not really move. So you sell a cash secured put with a $45 strike price, putting you on the hook to purchase 100 shares of XYZ at $45 per share on or before the expiration day. So if you did this, let's just say as an example, $500 premium you receive, pretty high for that if you're getting $500. I mean, I guess that's actually about what? 1% or 10%, of the trade price if you're investing $5,000. So it's actually quite a substantial premium. Once again, we're just using this as an example, and so it's going to be a lot less than 10%. If it's out of the money, there's no way you're going to be getting $500 for one options contract up front. That's $5 out of the money. Even if it's a couple months, I mean, it's going to be tough to do that. That's a pretty substantial amount of the trade right there, 10%. But it possibly could be done. But just bear with me as the example goes on, because you'll see some real life examples next after we go back to Thinkorswim. So on expiration day, if the stock is above $50 per share, you keep your premium and don't buy the stock. If the stock is below the strike price of $50 per share on expiration day, you are obligated to buy the stock at $50 regardless. So if it's trading at $45, $40, $35, it does not matter if the stock drops to 50 cents. You're still on the hook. So then your max loss, you can think about where the share price is. If it goes down to 50 cents per share, or even if it goes bankrupt, minus the premium, that's your max loss. And so if the stock goes to zero within the time of the cash secured put trade, you're still on the hook, and somebody is going to exercise you on that, I can promise you, because they want that opportunity to get off on the lifeboat if the stock goes bankrupt or something like that happens. And so that's what you're looking at with cash secured puts. It's basically the buyer has a lifeboat to get out at the strike price. Now you as the seller, you're on the hook, and so that's the big risk, and so that's why you're compensated from the buyer of the put option for taking the risk that it goes below the strike price. But when you think about it, for every buyer there's a seller. It really is a zero-sum game. Somebody's buying, somebody's selling. Now you're going to have some people who are buying to close, so that can be something that happens, and then selling to open, right? You're shorting, but nonetheless, it's buyers and sellers, so it's a zero-sum game with options. There's a winner and there's a loser, okay? So just remember that with options. the stock market works the same way, but there's some differences. Like with options, it literally is a zero-sum game. Like there's no in between. So examples of cash secured put trades. So once again, we're going to go over to Thinkorswim, and I'm going to do that in the next video here. But just want to go over the summary of cash secured puts one more time before we exit. And one more thing to keep in mind is that any broker should allow you to place these trades with the proper options approval. So really it comes down to your specific brokerage and if they're going to allow you to trade these options. But most brokers, I mean, unless you get some really sketchy broker that's like, no options at all, then you should just find another brokerage because there's plenty of options out there. But so cash secured put summary. Now this is the last page I want to go over, and then we're going to make a separate video here going into the specific Thinkorswim examples. I'll show you some charts and stuff in the next video, and we'll go into that more in detail. So cash secured put summary, can be used to slightly hedge a portfolio, increase the rate of return for regular passive income. It's also good for traders looking to buy stocks only if they hit certain price points. And so once again, the stock's trading at $100 per share, but you believe it's going down to 90. You sell that cash secured put at the 90 strike, and worst case, you get long at the price you thought it was going to. And if it goes lower than $90 per share, so be it. But the main thing to keep in mind with cash secured puts is that a lot of stocks will have what's called a support level, right? The S&P 500 even, or the SPY as an ETF, you could do it against an exchange-traded fund like that. And I'll show you an example of how that could work. But essentially, $90 per share, you sell that put option, and you're on the hook to buy at that price. But if you think it's going down there to begin with, let's say that's a key support level, like let's say it's tested that level once or twice in the past, maybe multiple times, and you think that's a good level to sell against, I mean, that's really what it comes down to, and that's kind of what you want to look for when it comes to cash secured puts. You don't want to do it after it's had a big extended move, because if a stock has gone up a lot, the question is how much longer will it go up, right? Now, sometimes you get those massive moves, but nonetheless, it's much better to actually sell cash secured puts that are out of the money still, if you can, like at a certain support level, and really do that like after the stock's been in a sustained downtrend, because probably what's going to happen is that the stock will go back up eventually, unless it never recovers. But if you have a strong company you're doing it against, like Apple or Amazon, Microsoft, you'll often see it hit those certain levels where you can sell those cash secured puts against and get the premium. In worst case, you end up buying at those key support levels. All right, so that concludes this video, but we're going to go ahead and get into the next one here, which is the Thinkorswim actual walkthrough, and I'll show you guys how to place these trades, and I'll see you guys in that one soon.